Have you ever wondered how professional traders like Warren Buffett pick their stocks? Or ever wished you could look at a company's financials and instantly know whether it's a good investment or not? Sounds like a superpower, right? Well, in this video, we're going to equip you with that superpower as we're going to explore the ins and outs of fundamental analysis. Hello, everyone. Welcome to part 2 of our video series on market analysis. In this video, we're going to focus on fundamental analysis, which is the art and science of evaluating the financial health and performance of a company. Whether you're a beginner or a pro, there's something new and valuable for you in this video. So stay tuned, because this could be the game changer you've been waiting for. But before we get started, do me a favor and hit the like button and subscribe so you don't miss out on our latest tips and tricks. It's totally free and helps us keep creating awesome content for you. All right, let's go. Now, while watching the video, pause on important points, write them down, or even watch certain parts again to better understand them. Remember, going over the video a second time can help you understand it even better. So, to start with, fundamental analysis is based on the idea that the value of a stock is determined by the underlying value of the company. By studying the financial statements and ratios of a company, we can assess its strengths, weaknesses, opportunities, and threats. Fundamental analysis is important because it can help us make informed investment decisions. It can help us in 4 basic ways. First, to understand the financial health and stability of a company. Second, to evaluate its growth potential and competitive position in the market. Third, to assess the quality of its management team and its ability to execute its business strategy. And last, to identify undervalued or overvalued stocks that may present investment opportunities or risks. So how can we use the financial statements and ratios of a company for fundamental analysis? In order to do fundamental analysis, we need to use financial statements and ratios that can help us measure and compare the financial health and performance of a company. We can use a tool like Yahoo Finance to access and analyze these statements and ratios. For example, here are some key financial ratios most professional investors are using. Earnings per share, EPS. It measures the company's profitability by dividing its net income by the number of outstanding shares. For example, Apple in 2023 had a net income of $97 billion and 15.44 billion outstanding shares. So if we divide $97 billion of net income to 15.44 billion shares, that gives us the EPS of 6.28. Price to earnings ratio, PE. The price to earnings ratio is a financial metric that compares a company's current stock price to its earnings per share. It's often used to determine whether a stock is overvalued or undervalued. A low PE ratio may suggest that a stock is undervalued, while a high PE ratio may suggest that a stock is overvalued. For instance, let's again consider Apple at the end of 2023. The market price per share was around 192, and the EPS was 6.28. The PE ratio for Apple would be calculated as follows. PE equals market price per share of 192 divided by EPS of 6.28 equals 30.57. This means that at the end of 2023, investors were willing to pay approximately 30.57 for each dollar of Apple's earnings. This PE ratio can then be compared to other companies, or the market average, to determine if Apple's stock was overvalued or undervalued at that time. However, the PE ratio is one of the most misunderstood metrics in financial markets. Many amateur retail traders might interpret a low PE as cheap and a high PE as expensive. But in the world of finance, terms like cheap and expensive are relative. Most professional traders ask, how much is the market willing to pay for a company's future earnings? Or, at what price is the market willing to sell a company's future earnings? A PE ratio that is higher than the sector average suggests that investors are willing to pay more for the company's earnings, often because the company is growing and the stock price is rising. On the other side, a PE ratio lower than the sector average suggests that investors are paying less for the company's earnings, possibly because the company's growth is slowing or even declining. Let's see an example. Let's say that the technology sector PE average is at 25, and we have to choose between the company A that has a PE ratio of 15 and the company B that has a PE ratio of 30. Professional investors would choose the company B while the earnings are more expensive. Investors are paying more money because the company evaluates itself as more expensive for a reason. And of course, if you check historical real examples of stocks that the PE ratio was above sector's average, you can see that most of the times the stock price is growing more or even faster than other stocks with lower PE ratio within the same sector. If you're interested in learning more about this perspective on the PE ratio, you can conduct further research. Alternatively, feel free to comment below, and we can analyze more this topic. Let's continue with the financial metrics. Dividend yield. It shows the percentage of dividends paid out by the company relative to its stock price, which can indicate its income potential for investors. The dividend yield is calculated by dividing the annual dividends per share by the market price. The formula is as follows. Dividend yield equals annual dividends per share divided by market price times 100. Let's continue with Apple as an example again. So, we do 0.95 annual dividends per share, divided by $192 of share price at the end of 2023 times 100 equals 0.49%. This means that at the end of 2023, Apple's dividend yield was approximately 0.49%. This ratio can give investors an idea of the income they might expect for each dollar they have invested in the stock. The next one is current ratio. It measures the company's ability to cover its short-term liabilities with its short-term assets, indicating its liquidity position. The formula is current ratio equals current assets divided by current liabilities. For Apple in 2023, the current assets were $143.56 billion, divided by the current liabilities of $145.31 billion equals 0.99. A current ratio below 1 indicates that a company has more current liabilities than current assets. This could suggest that the company might struggle to pay its short-term obligations or debts that are due within a year. However, a current ratio below 1 isn't necessarily a bad sign. It could simply mean that the company operates with a high level of efficiency, turning over its inventory quickly and having good credit terms with suppliers. But if the current ratio is too low, it could be a red flag for potential liquidity problems in the near future. As always, it's important to consider the current ratio in the context of the company's industry norms, historical performance, and other financial ratios. Another ratio we are using to check the company's health is debt-to-equity ratio. This ratio compares a company's total debt to its shareholders' equity, reflecting its leverage and financial risk. The formula is debt-to-equity ratio equals total debt divided by shareholders' equity. The Apple company in 2023 had a total debt of $111 billion and a shareholders or stockholders' equity of $62 billion, so the debt-to-equity ratio would be 1.79. The next one is return on equity. Return on equity measures the company's profitability relative to its shareholders' equity, indicating how efficiently it's using its equity to generate profits. The formula is return on equity equals net income divided by shareholders or stockholders' equity times 100, and it's a percentage metric. The net income of Apple in 2023 was $97 billion, and the stockholders' equity was $62 billion, so the return on equity would be 156%. Then we have price to sales, PS ratio. This ratio compares a company's stock price to its revenues, providing insight into how much investors are willing to pay for each dollar of sales. It's the same idea of PE ratio. A price-to-sales ratio that is higher than the sector average suggests that investors are willing to pay more for the company's revenues, and so on. The calculation is PS ratio equals market price divided by revenue per share. Revenue per share is like the earnings per share that we previously talked about, but instead of dividing the net income by the outstanding shares, we divide the revenue by the outstanding shares. The market price for Apple was at $192 divided by the revenue per share of 24.82, so the price-to-sales ratio would be 7.73. The next one is price-to-book, PB ratio. This ratio compares a company's market value to its book value, giving a sense of whether the stock is undervalued or overvalued. Again, it's the same idea of PE ratio or the PS ratio. A price-to-book ratio that is higher than the sector average suggests that investors are willing to pay more for the company's equity, and so on. The calculation is price-to-book ratio equals market price divided by book value per share. The book value per share is calculated as follows. We divide the total shareholders' equity minus the preferred equity by the outstanding shares. So, the book value per share is stockholders' equity of $62 billion minus 0, while Apple doesn't have a preferred equity. divided by 15.44 billion outstanding shares equals 4. Then we can calculate the price-to-book ratio by dividing the market price of Apple at $192 by the book value per share of 4, so the PB ratio is 48. And the last we are going to talk about is profit margin. This ratio shows what percentage of sales is left after all costs have been subtracted, providing insight into the company's profitability. The formula is as follows. Profit margin equals net income divided by the total revenue times 100. The net income of Apple in 2023, as we said, was $97 billion divided by $385 billion of revenue to have a profit margin of 25%. So that's the company's profitability ratio. It's also important to compare these financial ratios with other stocks in the same sector. For example, let's say we're analyzing two companies in the technology sector, Apple and Amazon. In a hypothetical example, Apple has a higher EPS, higher PE ratio, better profit margin, a debt-to-equity ratio of less than 2, while Amazon that has lower EPS, lower PE ratio, worst profit margin, and a debt-to-equity ratio of more than 2. In this example, we would have bought Apple shares while the chances of the investment to be more profitable and potentially overperform Amazon in the long term are bigger. Now that we know what fundamental analysis is and how to use financial statements and ratios for it, let's see how we can apply it to our trading. Here are some steps we can follow. 1. Research and selection. Choose companies that align with your investment goals and conduct thorough research on their financials, industry trends, and competitive positioning. 2. Financial statement analysis. Analyze the company's financial statements to assess its profitability, liquidity, solvency, and efficiency using key ratios and metrics. 3. Industry and market analysis. Consider the company's position within its industry and evaluate broader market trends and economic indicators that may impact its performance. 4. Comparison with peers. Compare the company's financial ratios with those of its competitors in the same sector to identify relative strengths and weaknesses. 5. Investment decision. Based on your analysis and comparison, determine whether you could buy the stock, short sell it, or do nothing with the specific stock, and just look for another one. Make informed investment decisions accordingly. And that's it for part 2 of our video series on fundamental analysis. I hope you found this information helpful and insightful. Don't forget to give this video a thumbs up if you enjoyed it, and subscribe to our channel for more valuable content. You can also write your questions below, or your suggestions for future videos. And please, for understanding the fundamental analysis even better, rewatch the whole video again or parts of the video you didn't understand 100% so you make it sink in your brain even better. In our upcoming videos, we will individually dissect each component of both technical and fundamental analysis. Our next video will focus on the concepts of support and resistance areas and trend lines. These tools help us understand a stock's current position relative to its past price. After evaluating the financial metrics and identifying a promising stock to buy or sell, these tools can guide us in determining the optimal timing for our actions, whether it's the right time to buy, sell, or hold the stock. So stay tuned.